So, if you've been watching the foreign exchange markets this past week, you already know we've seen some absolutely intense market divergence. It was literally one of those weeks where the winners just kept on winning and the losers faced some seriously heavy downward pressure. Today, we're going to map out the entire FX landscape, taking a look at the undeniable, rock-solid strength of the British pound. But really, we are going to put our magnifying glass directly on the biggest mystery of the week, which was the absolute roller coaster ride of the Canadian dollar. Okay, let's dive into this. Here is our roadmap for today. Number 1, we'll cover the global FX landscape. Number 2, we're unpacking that CAD weakness. And number 3, we'll wrap up with our conclusion and outlook for the days ahead. All right, part 1, the global FX landscape. Let's look at the winners, the losers, and the volatility. So this week's currency market was, well, highly polarized to say the least. We can basically chop the market up into 3 distinct tiers. Up top, in the strong tier, we have the British pound and the US dollar. These two essentially moved in perfect tandem. They both enjoyed a nice midweek rally and maintained a super strong finish to close out the week. They were the undisputed heavyweights for sure. Then, down in the middle tier, things get a bit messy. You have the euro, which rallied midweek but then fell back down much faster than the pound or the dollar, kind of leaving it in this sideways volatile pattern. The Australian dollar, interestingly enough, saw the lowest volatility of all major currencies. It really just traded flat in a super narrow range. But the New Zealand dollar, wow! The Kiwi saw massive, extreme swings. It surged early in the London session, only to quickly dive, basically bouncing wildly between bullish and bearish sentiment all week long. And finally, down in the weak tier, we find the Swiss franc and the Canadian dollar. Both of these currencies spent the week completely trapped in negative territory, but what really set them apart was their high volatility. And this brilliantly illustrates that extreme divergence we were just talking about. On one hand, you have the British pound, the week's undisputed strongest currency, just steadily marching upward, totally shrugging off any minor pullbacks. Contrast that directly with the Canadian dollar. It was the week's weakest currency, plunging early on and spending almost the entire week fighting just to find a floor. This extreme contrast, the prevailing, calm strength of the pound versus the volatile downward spiral of the Canadian dollar, is absolutely the defining macro story of the week. Moving on to part 2, unpacking CAD weakness. Let's break down the 4 converging factors. So how exactly did the Canadian dollar end up at the very bottom of the pack? We really have to frame this drop not just as a single, isolated failure, but more like a complex mystery that needs to be solved. The CAD didn't just stumble, it was hit by a combination of forces. There are 4 distinct layers of logic that basically created a perfect storm for the Canadian dollar this week. First, a sudden trade policy shock. Second, a glaring divergence in interest rates. Third, the absolute roller coaster of global oil prices. And finally, a surprisingly timed rescue mission from domestic jobs data. Let's investigate each of these one by one. Let's start with factor 1, trade policy. 75%. That is the massive chunk of Canadian exports that go directly to the United States. The U.S. is without a doubt Canada's most vital economic partner. So when the U.S. announced in early July that it would not simply auto-renew the USMCA, the massive trade agreement between the U.S., Mexico, and Canada, and instead initiated a formal annual review process, the markets kind of panicked. For Canada, that agreement is the absolute core guarantee of their foreign trade. This review triggered immediate fears of potential export tariffs. Institutional investors rapidly downgraded their expectations for the CAD's appreciation for the rest of the year. In fact, speculative short bets against the Canadian dollar surged to their highest levels since last November. It was a highly emotional, immediate sell-off that pushed the CAD to its lowest point of the week by Monday. But hey, the weakness isn't just about trade fears. Factor 2 is really the core, fundamental logic behind the CAD's medium-term weakness, and that is rate divergence. Look at the Bank of Canada. They've kept their policy rate stagnant at 2.25% for multiple meetings now. The Canadian economy is just lacking internal momentum right now, mostly because it's hamstrung by skyrocketing household debt and a really weak housing market. They simply don't have the room to hike rates. Actually, scratch that. The market had even started pricing in a potential rate cut. Now, contrast that directly with the U.S. Federal Reserve. Even though the Fed has slowed its pace, they are keeping their options wide open for further hikes this year. This creates a massive historic spread of over 100 basis points between U.S. and Canadian rates. In global finance, capital is like water, right? It always flows to where the yield is highest. With the U.S. offering significantly higher risk-free returns, global capital is literally being driven right out of Canadian assets and straight into the U.S. dollar. All right, now we add factor 3. Given Canada's traditional status as a petrocurrency, its value is deeply, deeply intertwined with global crude oil prices. Well, this week, geopolitical tensions flared up in the Middle East, specifically around the Strait of Hormuz. And as we know, whenever there is a perceived threat to oil transit routes, oil prices spike. That's exactly what happened midweek. This sudden surge in oil actually offered the Canadian dollar a temporary lifeline. It provided just enough energy sector support to prompt a small rebound and stop that early week bleeding. But here's the catch. As diplomatic efforts progressed and those tensions in the Strait of Hormuz started to ease, oil prices dropped right back down, giving up all their midweek gains. And guess what? The CAD fell right along with them. The data is showing us a really important long-term shift here. The historical correlation between the Canadian dollar and oil is actually weakening. A simple spike in oil prices is just no longer enough to generate an independent, sustained rally for the CAD. It can offer a temporary buffer, sure, but as we saw this week, oil alone cannot dictate independent strength for the Canadian dollar when other fundamental factors are weighing it down so heavily. Now, what's really interesting about factor 4 is that just when it looked like the CAD was going to close the week in a total freefall, Friday's Canadian June jobs report brought in a total surprise rescue. The market was expecting a pretty modest addition of about 10,000 jobs, but the actual data, it came in at 18,200 jobs added. On top of that, the overall unemployment rate actually ticked down slightly from 6.6% to 6.5%. This was a totally vital piece of good news. It immediately eased market fears that the Canadian economy was rapidly slipping into a recession, and it significantly lowered the chances that the Bank of Canada would be forced into a panic rate cut anytime soon. This specific data release literally saved the CAD from a total collapse, allowing it to narrow its losses and kind of stabilize just before the weekend hit. All right, bringing it home to part 3, conclusion and outlook. Let's talk about what to watch next week. If you are tracking the Forex markets yourself, here are the 3 clear, actionable takeaways you need to watch next week. First, keep your eyes glued to the incoming Canada inflation data. Like we talked about, the Bank of Canada is in a really tight spot. If inflation data comes in unexpectedly high or low, it's going to dramatically impact the market's expectations for Canadian monetary policy. Second, pay close attention to the scheduled Federal Reserve speeches. We need to listen to Fed officials to gauge if they're shifting their stance on the U.S. interest rate path. Any sort of hawkish tone is only going to widen that crucial rate spread we discussed. And third, continue monitoring Middle East geopolitics. The situation remains super fluid, and any escalation could disrupt those oil transit routes again, which instantly transmits volatility into oil prices and, by extension, commodity currencies like the CAD. Ultimately, until we see the dust settle on the USMCA trade review, and until we see a definitive signal that the massive US-Canada rate spread is actually beginning to narrow, it's pretty hard to see the CAD's fundamental weakness reversing. Which leaves us with this pretty provocative question to ponder over the weekend. Will the US-Canada rate spread finally begin to narrow, or is the Canadian dollar trapped in a perfect storm for the foreseeable future? Keep an eye on those data points next week to find out. Thank you so much for joining me for this explainer. I really hope this breakdown has helped you grasp the fascinating dynamics driving the global currency markets right now. Stay curious, keep learning, and I'll see you in the next explainer.